Welcome to Moffat on Money. I'm Clay Moffat, and this morning we'll be talking about the latest CPI release. Came in pretty hot. This could also be titled, how much worse is my 401k going to get, or how low can the market go? Some of what it's thinking so that you can make better decisions for your portfolio. I speak in generalities and share with you what I'm doing. Here's what I mean when I say core was at a 40-year inflation. Picture's worth 1,000 words. The have to go back to the early 80s when Paul Volcker and Jimmy Carter were president, Reagan was president, to find equivalently high inflation. Most of you probably weren't even born yet, but this is an impressive chart. What this means, how to, kind of how to look at this, interpret this, is that the core is the number the Federal Reserve looks at more than CPI because it takes out some of the volatile elements like food and energy that tend to fluctuate or vibrate more. So they pay more attention to the core, and the core is not really showing many signs of decreasing, maybe even increasing. So the Fed's pivot isn't happening. And by pivot, I mean the Fed switching from a tightening position to a looser monetary policy position, increasing the money supply again, which is what they did for the past 12 years. The market has feasted off of the Fed's free money for 12 years. It's addicted to it. That's their sole hope. Why you see these huge bounces, dead cat bounces, and we'll see more of them. It's the one idea that's fueled every bounce over the past few months is that the Fed is done tightening. But when you look at the actual data, you look at the actual numbers, you look at the Fed's own statements, Powell has been quoted as saying that Volcker gave up too quickly in the early 80s. Inflation dropped rapidly and then the Fed backed off, but inflation stayed high for 4, 5, 6 years and the Fed had to hike rates again. Powell has vowed not to repeat that mistake. Not only that, let's face it, the Fed has been tightening rates, hiking rates like mad, and has zero to show for it. What does that mean? Well, to the market, looking at the expectations from this morning, it looks like the market's now expecting the futures market anyway is now expecting the next Fed rate hike to be 100 basis points versus 75. So that's a pretty strong increase and pretty strong indicator that the Fed is not done hiking rates. It's going to get worse. Now, overall, the current situation, if you just look at kind of generalities going on in the market, the form and shape, structure markets, stocks are down a little bit so far as if they're oblivious to the Fed creating a recession or perhaps even a depression. VIX is down like we're in a bull market. Obviously hasn't gotten the crash memo. Housing prices have fallen as the bubble has popped. Rents have even dropped this month, according to Redfin. Now, in the Fed's data in CPI, it shows rents still increasing. But keep in mind, the Fed's data is 3, 4, 5 months old by the time it gets included in the CPI. So Redfin is taking more current samples. And actually, Redfin still showed some inflation, but the inflation rate has dropped. The key is inventory and housing is exploding. So you can look for housing to have a pretty severe drop ahead. Let's face it, like there's the old adage, you're only 9 meals away from anarchy. Well, the same adage applies to, people in real estate markets. If you know somebody in real estate markets, an agent or mortgages, they're only 50 basis points away from having to put up an OnlyFans site. So, say a little prayer for them. Other markets, commodities are down like inflation is gone. Treasury yields have soared. The 10 this morning was at a 20-year high. They're acting like inflation is, 15%. The market has split personalities. Different sections of the market are reacting differently. All of this while the general economic collapse continues. There's just not a whole lot to get excited about. If we look at investment sectors, gold, stock market, bonds, they're all down about 1% this morning. Here's some examples. The gold, for example, going along there through the beginning of October, boom, nice little drop there. Looks kind of like it's imitating a cliff. Well, how about stocks? Same with the stock market, Standard and Poor's 500. Nice little dump there. All right, well, let's try bonds. Whoops, bonds. Same kind of dump. All of the charts over the past year look the same. So for an investor, the only conclusion you can draw is basically there's no way to hide, at least in a productive market. So, I'm sticking in cash. I'm still in cash. I want to avoid these big drawdowns. Now, I'll miss some of the vibration, but what I'm doing is I'm very risk off, reducing the risk in my portfolio. That's a key to long-term management is missing the big drops. Now, there's other information out there that kind of shows the schizophrenia in the market. Our beloved Treasury Secretary Janet Yellen, who actually who is a former Federal Reserve chair. It's part of her genius that led us to the situation we're in today. Well, she was quoted the other day as saying, "We haven't seen any indications of financial instability in the markets." Huh. Well, that was 3 days ago. 2 days ago, she said, "I'm concerned about the loss of adequate liquidity in treasuries." And liquidity is a nice little code word for demand. There's no demand, or demand has fallen off for treasuries. That's a fascinating statement. The mix in Europe, Europe is important to the world economy. It's important to our economy. And it's having an energy crisis, and it will have a worse one this winter. They're already having long lines, and you don't see any mention of this in the American media. They're having long lines for gas. They're having people get in fights at gas stations. England, as we talked about last week, is on the verge of an economic collapse due to pensions failing. They're killing their tax cut, their much vaunted tax cut, which probably would help get the economy going a little bit more. But they're having to cut it because they would fund it with debt, financing through more gilts. Well, the gilt market's getting hammered. They can't afford it. So they're getting rid of their tax cut. Huge economic impact from some of the things that we're talking about. And none of it's good. You want more? I'll give you more. OPEC is cutting oil production. So expect energy costs to keep increasing. Food costs will keep increasing. We're having shortages in harvest, with lack of fertilizer because Russia's not exporting fertilizer. You've got the war in Ukraine. Ukraine is a huge breadbasket in terms of producing grains, as is Russia. Looking at other production of goods, Europe's production this winter with the energy crisis, lack of energy, people are already cutting firewood. They're cutting trees in anticipation of this winter. If it's a cold winter, a lot of the factories probably will have to shut down because of lack of energy to keep them going. And so, no BMW is produced, no VW is produced. Most anything that Europe produces will probably be in shortage this winter. Loss of jobs. You're looking at a pretty severe recession or depression. And if Europe's in a depression, it's going to throw us in one. Well, how about China? Well, China's shutting down major industrial manufacturing areas because of COVID again. They have a zero COVID policy and they're hammering the people. Well, the people are starting to riot. China's actually experiencing some riots now. So don't expect their production to increase, much less take up the slack of other nations who aren't increasing. All of this shortages will lead to continued or sustained inflation. So what lies ahead over the next few months? Follow the three big trends that have kept inflation down over the past decade. The three big keys to low inflation over the past decade. We had cheap labor, cheap food, and cheap energy. All of those, each one of those is done and over, gone, done with. Will be a year or likely several years before they can achieve some semblance of balance. You even see sell-side analysts now scrambling to try to revise their earnings per share forecasts that they just did 6 months ago. Consensus EPS growth in U.S. stocks has dropped from 10% to 3% already, and they're just beginning. Also, there is zero Zero talk of zombie corporations, companies that have more debt than assets. No discussion on their ability or inability to roll over their debt. They don't have the cash to pay off the debt. So what happens when they have to refinance their debt at two, three, four times the interest rate that they did previously? Again, not a good forecast for the future. So expect volatility at a minimum. You're going to see some good days, some really good days, some surprisingly good days. You see those in every bear market, even the Great Depression. For whatever reasons, it's normal in a bear market. But the market will drop further. The S&P is about 3,600 now, which is down 23% from its highs of 4,800. It very well could drop 30, 35, 40% from its highs. That would be not uncommon considering the circumstances, the recession, the other things that lie ahead. Now, understand, bottom line, there is no such thing as a soft landing in the economy when it's been bloated with years and years and years of artificially cheap debt. I might have said this last time. The problem is not that rates are rising. The problem is that they have been too low for too long. That's the fault of the Fed. There's simply no way to pull $30 trillion in global liquidity quickly, easily, without absolutely crushing a heavily leveraged financial industry, financial system. Both European and American, even Chinese, are heavily leveraged. So it'll take time to reduce, especially with the problems we have in food and fuel. Just a number of systemic problems out there. So if we look at history, in times when inflation rises in Western economies above 5%, normally it takes 7 to 8 years to get it back to 2%, which is the target. 7 to 8 years. The Fed doesn't want to wait that long, per chairman's and several governors' statements. So they're prepared to tank the economy, to put it into recession, maybe the worst recession of your life. Now, to help you with kind of getting through some of this, things to keep in mind as you look at your investment portfolio. There are stages in a bear market, traditional stages in a bear market. The first is the easiest to gauge. It's when all the weak hands fold. This is the inexperienced participant who tuck and run. Or let me just leave it at tuck and run. The second stage is multiple bear market rallies. And this is kind of what we're seeing now. You've got dead cat bounces, like I say, even in the Great Depression. The third stage is the one kind of we're looking for, the panic. With volatility just starting to rise, we're not there yet. The panic is not here. The fourth is the deflation, the depression, the capitulation, whatever you want to call it. This is when just everybody is just done. No hope. That's when you want to invest. That's your prime time. Now, when's this going to happen? I can't give you an exact date. It may be the fourth quarter of this year. It may be the first quarter of next, maybe the second quarter. The timing is inexact. But if you're looking for it, if you're prepared for it, you'll recognize it. And I strongly encourage you, a lot of what I talk about is risk, looking at risk in the market. If you do not manage your risk, if you do not control your downside, the market then becomes your risk manager, and it will flatten you like a donut in coffee. Remember, the market hits bottom when the Fed starts cutting rates, not when it's hiking rates. So, be patient, keep your powder dry. We're setting up for a 20-year recovery. That's when you'll make your money. Until then, protect it, guard it. Your day will come. Choppy markets like we're seeing now nobody knows what's happening. It's hard to explain why the market drops so much in one day or rises so much in one day. But choppy markets like this are death traps for investors. It's kind of like, entertainment to see the rookies getting, slapped around. Now, for those who want to take some small positions, who just feel like there are opportunities out there usually are. I mean, you've got to be reasonably smart. There has to be products that are independent from the economic crisis, will profit from the economic crisis, the recession, or that are independent from the financial crisis, the financial industry, the investment banks, the banks, et cetera. Companies like uranium, what's going to happen to demand for uranium over the next few years? Might be pretty good. The idea is, George Soros said in 2008. Now, I'm not a fan of Soros as far as his political positions and inclinations and donations, whatever, but he's done pretty well in the market. And he said, I would have made more if I'd taken smaller positions and stuck with them. Now, I know as an investor, I've screwed up a bunch, but I learn from my mistakes and I'm certainly try to learn from others as well. So that piece of advice is something I would strongly suggest. Buy good, solid companies, good ideas, good people, and stick with them. But don't be in a rush to invest. So keep your powder dry. Your day will come. Be in a rush or be more concerned about protecting your drawdowns, your downside risk. Risk off positions in cash for now. So it's what I'm doing. So I hope you found this somewhat informative. Hope you'll turn into my next video. Subscribe, turn on notifications, do all those little YouTubey things. Also on Twitter, and I'll try to continue explaining investment in choppy markets. If you have any ideas or future suggestions for topics, send me a DM at Twitter, Moffat on Money. My time is up. I thank you for yours.